It's a huge pleasure to introduce Jim Miller to the Squirrel Pod. Jim has been reading my research pretty much since I started, and he was kind enough to slide into my DMs the other day to put me straight on a small matter of capital markets. He was an equity capital markets banker of some repute during a long career that started at Merrill in the mid 1980s, and he cycled through Deutsche Morgan Grenfell and Lehman Brothers. I probably missed a couple, but Jim, welcome.
Well, thank you, Rupert. It's always great to get together with someone who knows the ECM business. It's a small fraternity, and we all suffer quite a lot of travel, but we learn a lot in the process of being in that business.
Well, what you really piqued my interest is when you let slip that you had been a fly on the wall in a pretty important moment in capital markets history that occurred 28 years ago today. And I guess an awful lot more people will have forgotten that probably the most iconic tech business on the planet, Amazon, was actually taken public by a German bank. Jim, why don't you tell us how the Germans
Well,
managed to win that particular deal?
pretty remarkable story, actually. In early 1996, Deutsche Bank decided it wanted to have a presence in the U.S. capital markets. And they went on a hiring spree that at the time was unprecedented. They brought in a fellow from Merrill Lynch named Edson Mitchell, who had been running the fixed income business at Merrill Lynch. And with Edson came about 200 or so people from Merrill Lynch. And they hired a fellow named Carter McClelland to run investment banking from Morgan Stanley. And I came in kind of at the mid to late part of that recruitment process. I was friendly with Edson Mitchell, having worked on transactions with him as a banker, and ultimately I got a call from Carter McClellan saying they wanted to have a meaningful ECM presence. So I ended up being the person chosen to run the U.S. equity capital markets business for Deutsche for this build out to go compete directly in the big leagues of investment banking in the U.S. markets. And at the same time, one of the most headline recruits was Frank Quattrone, who was the lead technology investment banker at Morgan Stanley, who obviously knew Carter McClellan well. And the first day I met Frank was a day, probably within my first week on the job. I was just walking around the equity floor, and this fellow was getting a tour, and I said hello, and he said he was Frank Quattrone. So that's how we met. I had been prior to that in my career at Merrill Lynch, not focused on technology at all. I had done a tremendous amount of emerging markets work, and had also done a lot in the energy business and the retailing business, but Merrill Lynch was not strong in technology, so that was not an
I'm
area
going
that
to
I had.
get you back next time to talk about the YPF deal, which
Yeah,
definitely that one.
that and Amazon are my two favorite experiences in the business, honestly.
So, I mean, Amazon was pretty well known at the time, and obviously, you know, Frank was a star banker to Silicon Valley, but to set up, and I'm going to put the cover of the prospectus up here on the on the on the t- on the screen now so that people can see it. I mean, a pretty brave call to have Deutsche Bank lead left on what was, it was a very high profile transaction, even if it was only a $50 million deal. I think we tend to joke around these days about zeros generally, but actually a $50 million IPO was a decent scalp for an investment bank in the 1990s.
Yeah, I mean, it was the normal minimum size to get serious institutional participation. And as you said, Amazon was a very prominent company. People were paying attention. And the technology business had a boom in the 80s when Apple went public and Microsoft went public, and then it went dormant for a period of time. And you'll remember from the investment banking business that the focus was on emerging markets then in the late 80s and into the early 90s. But by 1996, tech was up and running in a big way. And in 1996, there were 244 tech IPOs that raised $13 billion. And what people probably won't put in time sequence is that was at the end of 1996 is when Alan Greenspan made his famous comment about irrational exuberance because he thought this was crazy, these people paying these valuations for tech IPOs. And that sent the market into a bit of a tailspin for approximately 6 months. And it was really about the time of the Amazon IPO that the tech market turned around and reopened to
Yeah,
start what
I'm gonna bring up
became,
some slides for that because I think it's helpful. I mean, first of all,
yeah,
let's do that. So, I mean, this is Amazon in all its glory, from IPO to date, and we both had to do the maths before this to figure out that Amazon was actually IPO'd in 8 cents of today's money, and the story that we're going to tell is this bubble over here. But to reference the irrational exuberance moment, I think that's at the beginning of this pink box here, at the the very beginning of 1997.
exactly.
And the IPO was this time 28 years ago, so the 15th of May. So your timing couldn't be more perfect because things were just beginning to roof as you started the roadshow by the looks of things.
Yes. Well, fortune favors the bold. And I would say Jeff Bezos is nothing but bold. Um, but
So
you
what
had
was, I
asked,
mean, he was pretty bold to hire Deutsche to do this. What do you think? What do you think with the backstory around the mandate and the pitch was?
honestly, I think I would boil it down to Frank Quattrone's personal charisma. And Frank did something unique in the pitch. I was not at the pitch meeting, but Frank had the pitch book bound in hardcover like a book. And I think attention to the business in such a meaningful way, um, really struck a chord. And Frank personally, had as much experience as anybody in Silicon Valley, doing this business at the time. So, it might seem a little odd to pick Deutsche Bank, but it's like when you hire a law firm, you're really deciding which partner you want to work with. You're not picking the name of the firm typically. So I think that really is what's behind Jeff's decision.
I think that stunt with the hardbound pitch books was probably the stunt that launched a million imitations in capital markets over the next 20 years.
Yes.
I, you
Or,
know,
or, or like when Morgan Stanley won the Uber IPO a few years ago with the lead banker whose name is escaping me right now,
the
worked
one
as
he
an
was,
Uber driver for several weeks.
yeah. I remember going to pitch an IPO in Indonesia for a fish farm, and everyone was wearing fish ties. Uh, it never stopped.
So yes.
So,
And
just going, so that there was, so this was an amazing sort of true relationship call. I don't think that necessarily the market would have been super worried about Amazon having enough visibility at that time, but there certainly was no expertise in terms of how to value a business of such a microscopic scale. So, I mean, how was the valuation pitched?
well, the valuation was based on the discounted cash flow analysis prepared by the research analyst Bill Gurley. And Bill is now a very prominent venture
Of
capitalist, but
course.
at the time, Bill was a an analyst in the research department who had joined Deutsche Bank along with Frank's team.
Yeah, it's funny. I was having a look through the prospectus in preparation for this. The sort of the quaint language that was used. The opening line of the business description was Amazon.com is the leading online retailer of books. Since opening for business as the Earth's biggest bookstore in July 1995, the Amazon.com bookstore has quickly become one of the most widely known, used, and cited commerce sites on the World Wide Web. I mean, it's not even the use of the word buzzwords like e-commerce or World Wide Web
Yeah,
spelt out in full. And
right.
I mean, and the historical P&L numbers that you were playing with were, as I said, completely microscopic.
Yeah, the 1996 revenues were 15.7 million with an operating loss of 5.9 million. And the initial filing range was 12 to $14, which represented 19 times revenues, just to give you, a sense of. And it said in the prospectus they expected to continue to lose money for the foreseeable future with increasing losses.
Yeah, no,
So,
I mean, listen, journalists always love to sort of dig into the risk factors of prospectuses, which have just got longer and longer as our careers gone on, and they always try
yeah.
and make a story out of a risk factor. But that was a particularly wild one on the earnings disclaimer. Um, but in terms of was this a roadshow where accounts were begging for a one-on-one meeting with Bezos, or was it a little bit calmer than that?
Well, I think it was a hot deal.
Yeah.
But there's a pecking order of, who gets the one-on-ones, and I think it followed pretty much the normal track it was about maybe a 7-day roadshow, if I recall, 6 or 7 days, and it was visits to Boston and New York and San Francisco and all the Chicago and seeing all the one-on-ones with people like Fidelity and Ron Barron, the growth stock manager, and T. Rowe Price, and it's all I would call it all the usual suspects. There was nothing unusual about the deal in terms of who was visited. But I think what was unusual about the deal is the investors weren't buying Bill Gurley's DCF analysis. And they were all saying, this is sandbag. This company's going to do much more. And all Bill would give them credit for was to sell books. And I think the investors were looking forward that, this company has a platform to sell much more than books. And in the future, it's not going to only compete with Barnes and Noble. It'll find other things it can do. I don't
Were
think
they
anybody
actually?
had a vision of where Amazon is today, but I think there was a belief in an upside that they would be able to use their technology platform to sell more than books.
Yeah. Were they already selling CDs by the time they went public?
I don't remember off the top of my head.
Yeah,
They may
it's
have been.
it, it's interesting because the point you made about the prior year and 244 tech IPOs raising $14 billion was that most of those deals were up 50 to 100%. So you're talking about $14 billion of P&L to investors that occurred during
That's correct.
1996, which is clearly why these little $50 million deals were getting a lot of attention from some of the biggest people. But what I think people forget is how, yes, like all tech IPOs, Amazon.com got its day one pop, but the story after that was very different. I've got a chart for you here, Jim.
Yeah.
So just so that I can explain it for people following on video, I've got in the red and green candles, you've got the stock price chart for Amazon during 1997, and then in the background you've got the Nasdaq, right? Just to give you an idea of where it's moving in line. But fantastic debut. But the next week was not the same story, was it, Jim?
No, it wasn't. And just before we go into the trading, I think it's worth spending a minute on the pricing meeting.
Oh God,
Uh,
yes, absolutely, yeah.
because the pricing meeting itself was quite an experience. We met after the close on a Thursday evening in a small conference room off the side of the Deutsche Bank trading floor, which had a square table that could fit three on each side. So it was a very small conference room with barely enough room to back up your chair. Um, and I was sitting, was facing away from the trading floor. Next to me was Joy Covey, who was the CFO. Then Jeff sat on the corner, caddy corner to us, and then Frank Quattrone, and then Bill Brady lining the other side of the table. And we had raised the price range from the initial 12 to 14 to 14 to 16, but we still had enough demand to go above the range. So it ended up being a 3-hour discussion as to what was the right IPO price, whether it should be $17 a share or $18 a share. And the other person from the pricing committee who was on the phone from an airplane, if you remember back then, we had those little phones in the private planes that you could make a phone call with, was Scott Cook, the founder of Intuit, who was on their board, and he was the other member of the pricing committee. And he got fed up and hung up after an hour. I don't know what the phone bill was
Yeah,
from
I
a
was just
private
gonna,
plane for that call, but it was a lot. But I guess the back and forth was about the objective of the IPO, from my perspective, was to build a supportive shareholder base that they could come back to and raise additional capital as they grew Amazon. And Jeff understood that point, but he also wanted to maximize his proceeds in the IPO. And we went around and around and around on this issue. It took 3 hours. And finally, in the last couple of minutes, Jeff said, I can do better for the shareholders if I get $3 million more to spend on advertising than I can by having the goodwill for my next capital raise. And I couldn't disagree with that. That made a logical sense. And so that's how we arrived at $18 a share rather than 17. Uh,
I think he's right. I
so
mean, I think if in your if you totally are dispassionate about it, Jim, even the highest quality names in the book, Fidelity with their 5% allocation at the top, they were gone on a 60% pop, whatever happens. So, I've made that argument so many times in the past that, you've got to cultivate the right register, etc. But in this kind of IPO pop world, you start to get on very thin ice, I think, with those arguments.
Well, I think that's true. But remember, this was a problem back then when IPOs were so small. You had to get enough into the hands of an investor that they cared about the position. And I agree with you. Fidelity's the biggest flipper in the IPO business, 100%. But anyway, um, so we got the deal priced, and got the allocations out, and back then, of course, Nasdaq didn't have their TV studio in Times Square. There was no way to have any particular ceremony, but Jeff Bezos's mother came to the trading floor at Deutsche Bank to watch the beginning of trading. And it wasn't a fancy trading floor at all. And the head NASDAQ trader was a guy named Tony Canary, who had also come from Morgan Stanley. And Tony was at his desk with Jeff's mother standing like 2 feet behind him, wearing all black. I don't know what the purpose of the all black clothing was, um, but we got all the aftermarket orders together. We got it organized into 23 bid, 24 offered. Looked like we achieved exactly what we were trying to do, a good pop, but not insane, with both sides of the market spoken for. And about 10 seconds before the open, and back then all the NASDAQ trading happened by phone. So Tony's phone rings, his direct line from Herzog, Heine and Geduld, which was one of the small New York NASDAQ traders. And they said 29 and a quarter bid for 100,000 shares. And Tony was like flabbergasted, like, we have this whole market organized, and now you're bidding 29 and a quarter. You're 5 points above the market. Okay, sold to you. And while this conversation was happening, the trading started. So the actual first tick occurred at 29 and a quarter, even though the institutions were really only 23 bid, 24 offered. So that created a massive outflow of the entire shareholder base. And then the stock slowly ground its, and that the 29 and a quarter, it turns out, we later discovered, was Herzog had accumulated market on order openings from small brokers all over the country for retail customers. So they filled the retail customers at 29 and a quarter on their market on open, and then covered their short to those retail customers as the price degraded over the course of the morning. And the stock traded all the way back down and closed at 23 and a half, which is right, where we had targeted it. But the damage had been done at that point, to the point we were talking about before. We didn't have supportive shareholders anymore.
Oh,
All of the
they've been
people,
taken out.
yeah,
They've been
they,
taken
they
out
they bought it
completely.
at 18. They achieved a 26 or $27 average sale price. That's 2 to 3 years of appreciation. So we lost all of the major institutional shareholders that that had a view on valuation and had enough money to put to work to do something about it. So you see that the stock then conceded to, it succeeded in trading down the next 4 days, and finally it went below the IPO price on the, what is it, the fourth day, the big negative
Yeah.
candle there.
Yeah.
And we had used up the green shoe, if I recall correctly, and we were looking at the stock going to
Jim,
15.
just pause 1 second and just explain the over allocation option quickly, just to people
Yeah,
that
yeah, sure.
aren't
So
familiar.
the green shoe is actually the term used because the first company ever to do this was the Green Shoe Company, which is now known as StrideRite. But the idea is that in an IPO, the underwriters sell 15% more shares than is being officially offered, and they go short those shares to the market so that they have the ability to purchase shares back if the offering is trading weak. And they get an option from the company to buy those 15% additional shares from the company to protect themselves against loss if the stock trades up. So it's meant to be a mechanism to help stabilize an IPO and prevent it from dipping
In
at any
those days,
moment.
Jim, you couldn't stabilize above the $18 offer price. So
That's correct.
you were buying all of those shares, and you still can't, but you're buying all those shares below 18. So you must have evaporated that shoe on kind of day four very quickly, trying to defend deal
Yes.
price.
Yeah, I mean it's not a lot of stock. I can't read the volume clearly
No,
here,
no,
but
no. Yeah,
you can see those candles the bars for volume are quite
yeah,
large.
yeah, they're pretty big. They're pretty big.
And so what happened at that point is the head of equities, who was a fellow named
It's
Ted
also worth
Neckerson.
noting that the stock was cratering against a pretty strong Nasdaq tape, right? So
That's right.
it was a horrible relative print too.
That is right. I mean, like I said, we had lost our sponsorship for the shares in the institutional market, and
So
so the
what
head of
happened
equities.
next in a move which would not be repeated in 2025?
No, that's correct. The head of equities is a fellow named Ted Neckersummer, who had been the head of C.J. Lawrence, is the boutique firm that Deutsche Bank had acquired to get into the equities business. Said, we can't allow this thing to go any lower, or it will blow up the franchise we're trying to build. So we're buying 1 million shares at 15 to stabilize the stock as principal.
Yeah.
So that's a third of the offering, a third of the public float. And we did that. And you can see then the stock finally stabilized and started to trade on its own. But it still didn't really go anywhere until July when it
So
started
yeah,
to take off.
what happened there? It wouldn't have been maiden earnings, would it? What was
I
what kicked it off there?
I don't honestly remember exactly what happened at that point.
Well, the market was the broader market was
The
definitely on
the
the
broader
up.
market was flying.
Yeah. It is extraordinary. I mean, you know, obviously post GFC, the idea of underwriters getting that actively aggressively involved in aftermarkets was yeah, was preposterous. But I mean,
Yeah.
you know, investment banks getting actively involved around new issues in the late 90s, early 2000s was pretty well established. I mean, it wasn't a crazy thing to do.
Yeah,
And
but
also from the perspective of Deutsche with a brand new ECM franchise in the US, it was existential.
that's correct. And that was the judgment that Ted made, and it worked out for everybody.
Did you get the follow-on business, or was when was the next follow-on? I think they did a
I
bunch of
it
converts,
was
didn't they, after
Yeah,
that?
they did a bunch of converts many years later. They didn't and I left Deutsche Bank in 1999. So there was no follow-on business in the next 2 years that I'm aware of.
So let's pause a little bit because obviously, I mean, Frank Quattrone's an interesting character, and I think he must have left Deutsche pretty soon after that to start the business. He moved his franchise to Credit Suisse, right?
That's correct.
And
And
that's
but it wasn't that, it was at least another year later. About
okay.
another year later, I believe. Because
I
we
mean,
I remember we did do a number of convertible bonds for some of his tech clients, and we did a deal for Manhattan Associates the following spring, which is a software company that he was involved with. So I would say he left approximately a year after that transaction. And
And
as you said, moved his entire franchise to Credit Suisse.
And then, obviously he was exonerated after many years after the event, and obviously has his own business now. But you had the whole Friends of Frank scandal around the final phase of the Silicon Valley and tech fundraising cycle. It would be really good fun to sort of talk about that final stage of the blow off top in tech markets, because in May 97 we still had 3 years to go, right?
Yes,
And things got even crazier. And I do think about the
much crazier.
parallels. I do think about the parallels to what we're going through right now. Are we in the 98 foothills, or are we in 2000? And that's the question we're all trying to answer for ourselves right now.
Yes. Well, the Friends of Frank thing was very controversial. And he was already trying to do something along those lines at Deutsche Bank. So, what the Friends of Frank was about was Frank would recruit CEOs and CFOs of tech companies in Silicon Valley to become retail customers of the firm so that they could buy stock in the next hot IPO.
Yeah.
And he would allocate, he would want to allocate stock to those individuals so they could profit and would want to do their investment banking business with him to stay in that loop. And coming from Merrill Lynch, this was something that was completely foreign to me. We had at Merrill Lynch very strict rules. I don't think any retail customer could buy more than 200 shares of any IPO, period, end of story. So I was extremely uncomfortable with that idea and essentially refused to participate in it. And they ended up hiring at Deutsche Bank a fellow named John Schmidt to run a separate retail business for Frank to accommodate these transactions and these customers. And John had, I think, two other guys working with him, moved to Credit Suisse with Frank, and was ultimately, I don't know that they ever brought charges, but he was dismissed from CSFB and was potentially facing federal fraud charges that maybe he was indicted, but they never brought the case or something. But he was
I think there was
ultimately,
the famous line, "This would be a good day to clean up your files."
well, that's a
Wasn't
different thing.
it? Oh, well, that
Yeah,
was a
so
different
so
one, was
that
it?
was that was one part of it. But then Frank himself, he had a reputation for flying very close to the wind in terms of the rules, and there were other things going on in Frank's business. In the institutional side of the business, if somebody was getting an IPO allocation and made $1 million, they would ask them to do a special trade with them to give back half or a third or 20% of the profit by trading, let's say, 1 million shares of General Electric at a $1 commission instead of a 6 cents commission.
Yeah.
So they had that piece of it going on. And the other thing that was going on was when he went to Credit Suisse, Frank got control of a $60 million venture capital fund that he could allocate venture capital investments to his team at his sole discretion. So there was all kinds of interesting things going on. This is all hearsay for me, but I was very close friends with the guy who tried to negotiate Frank to stay at Deutsche and not go to Credit Suisse, and I'm familiar at least with this whole venture capital concept.
My
So
word.
Frank got in trouble for sending an email to his team saying, "Clean up your file. It's time to clean up your files," something like
Yeah.
that. When it became clear to him that there would be some sort of investigations into their business, and he,
Yeah.
I believe, was tried 2 or 3 times and got hung juries, and was never found guilty, and eventually started his own new business, which I think he's still running in Silicon Valley.
I believe so. I think it's well, it's obviously M&A focused these days, but he's been
Yes.
behind a lot of the big tech mergers. Um, let's fast forward to today, and the shocking state of the US IPO market. What needs to be done to fix it, right? How can we have
Yeah.
such crazy, you know, I mean, some real animal spirits in equity markets, but really not an IPO market to speak of?
Well, I think, first of all, I'm very glad I'm not in the business anymore.
No, me too.
Um, but I think the underlying cause is the massive amount of liquidity in venture capital and private equity, and the pressure on the private managers to keep their marks up. So in venture capital, when you go from your C round to your D round to your E round, each time a new investor comes in, they get what's called anti-dilution protection.
Yeah,
So they can put a headline on, we've just valued this company at $6 billion, but that 6 billion is meaningless because if the next time they raise capital, they raise at 2 billion, they downward adjust the valuation and make the investors whole by diluting the earlier
the earlier
investors.
ones. Yeah.
So the concept of the private marks and the need for the venture capitalists to keep those climbing allows for this, I call it almost a non-market pricing system to perpetuate. And so if the private market, I don't care, I'm Benchmark, I've got money, and I'm not trying to pick on Benchmark, I'm just picking a name. I've
Yeah.
got money burning a hole in my pocket from the fund I raised 3 years ago, and I have to put it to work. I don't really care if I put money in something at a $5 billion valuation when I know it isn't worth it, because if they raise money lower, I get reset. So there's not the strong incentive for pricing honesty in the private. Same thing with the LBO firms.
Yeah,
And
absolutely.
so the public market, however, is going to give you a true independent valuation. And so the private managers are disincentivized to go public unless they can beat the insane valuation that was the face number on the private round. And so we've got this sort of dislocation where it
So, but
used
if
to
you
be
were
the
if you
most
were
liquid
ki-
and best price came from the public markets, and now it doesn't.
but if you were king for a day and someone put you in charge of the SEC for a week or some other appropriate, well, how would you unplug it? Because it feels to me like the whole private market needs a massive purge before we can get proper price discovery back for a huge swathe of assets.
I think that's exactly correct. I mean, I think what I would do if I were the, SEC commissioner is I don't know whether it's within their purview, but trying to get some kind of truth in marks in the private equity and venture businesses, that
Yeah, properly audited.
they
I mean,
not just be the general partner's assessment, that there be some kind of a independent valuation.
yeah, it's going to be a headache for all of those endowments. I mean,
Yes.
it really is. I mean,
It's like a game where the pension funds and endowments and the private equity managers are linked, where they can't separate. They both
no,
need each other, and it's not good for any of them for the truth to come out. We've seen recently Yale and Harvard both talking about selling some of their private positions, but at the same time, we see new funds coming up to buy secondaries. And I'm not sure who's managing those or how they're going to price them, but
well,
we're not
it's all the
getting
same.
clear price discovery.
It's all the same money coming around. And what are these guys? They're going to buy at a discount, and they're immediately going to mark it up to the fiction level that it's being held at in the other funds that they just bought it off. Yeah, it's dangerous, and I don't really see how it purges now. One way that we have seen happen in recent years is rather than have the price discovery process of a stock offering, we've seen these listings by way of introduction, and
Yeah.
then this is what I call the Palantir stunt, where you freely list the shares. There isn't a pricing moment per se, but you set it up so that the machines of ETF land suddenly take you take create a sort of perpetual motion machine. I would kill that in a heartbeat. But it
Yeah.
may be it may be the only answer is to say, actually, all of these, all of these aging unicorns now need to be floated, right? There's going to be listings by way of introduction for all of them. Let the market decide what they're worth.
Yeah, and again, the way those contracts are written, though, there's really no pressure on the managers, on the private managers. And the other thing I would say is, this is maybe a little off topic, but I am a huge fan of Dutch auctions. And I was actually ran two of them for the Argentine government when they sold off their telecom companies. Telecom Argentina raised 858 million, and Telecom raised over 1 billion in Dutch auctions. And we figured out a way to pay commissions for the people who got the orders, and
Well,
it
that's how
worked
Google did
beautifully.
it. That's how Google went public
Google did
originally.
it, but Google was somewhat boycotted by the street, and people
Yes.
wouldn't talk about, the analysts weren't focusing on it. So Google sort of underachieved. What we did in the Argentine deals is we paid a commission to the introducing broker. So the orders had to come through a broker, and then
Yeah.
the broker got a sales commission if they introduced a winning order in the auction. And that seemed to work quite well.
Brilliant. Any other takeaways for the deal space of 2025? I think we've probably given the PE shops a hard enough time. What?
I mean, the last deal I participated in didn't go well. So I'm not very happy with the IPO market myself right now.
Well, I have to say I've been keeping an eye on CoreWeave in the last few days.
Yeah.
Clearly they did a very tight stop. Half the deal went to three hands, and um, then it was prematurely released from syndicate, and the options got opened up, and they got carried away by the perpetual flywheel. Um, Clearly they're officially locked up by Morgan Stanley for another 4 months, but I do see some short interest creeping higher. I wonder if that might be about to sneak out of the gates now that it's up 60% from deal price. So let's see.
Yeah, we'll see.
Jim, thank you so much for doing this with me. This has been so much fun, and I think we're going to have to dig deep on Argentine deals next time we do this. It's a lot of fun.
Excellent. Well,
Thank
Rupert,
you
thank
so
you for
much. Oh,
having
and
me
I
on.
listen. I actually, before I finish, I do want to say that Jim has a Substack. You don't write it very often, but it's a really great need, and it's comments from Connecticut's right name,
That's
isn't it?
correct. Yes.
Please do give Jim a follow. And for subscribers of mine, he's the one with the Union Jack avatar in the Dre. So go say hi to him there too. All
All
right.
right. So long.
Thanks, Jim.